Hi everyone. This is the 10th lecture of Monetary and Financial Economics B2. Today we will continue our discussion related to the financial globalization. So these are today's contents. The first one, the global financial crisis, GFC of 2007 to 2006, 2009. And then second topic is international regulatory initiatives after the global financial crisis. The third one is metrics for the international capital market performance. Okay, let's first move on to the first topic, the global financial crisis. The background of the global financial crisis is a boom in the US housing mortgage market. The boom is caused by low interest rates, environment, and rising home prices. So the U.S. housing mortgage market provided the subprime loans for borrowers with bad credit. Such borrowers owned their homes for a short time and then sold their homes for profit. Because the home prices increased, so such borrowers can easily get gains from buying and selling homes, houses. Okay. Many borrowers did not have enough funds to repay their loans when interest rates rose. So there is vulnerability to the interest rate increasing. In 2006, the Fed began tightening monetary policy to avoid inflation. Then US interest rates started to rise and home prices began to fall. So the key concept of several background in the several financial crisis is securitization of subprime loan. The securitization means that selling assets to customers by turning them into securities. Subprime lenders then sell loan rights or claims as securities. So there is borrower and lender. There are borrower and lender. They made loan contract each other. In the loan contract, borrowers must repay the loans in a particular date. Then lenders sell the buyers of securities. So lenders sell the securitized subprime loans to buyers. Then buyer own the loan rights. That is, at a particular time, they can get paybacks. Okay, so this is securitization. So the key concept that the securitization is the background of several global financial crisis impact. Okay. The single securitized, so the single so sorry, it's hard to pronounce again. Securitized, okay, securitized. A single securitized contract is very simple, like that. There is borrowers and the lenders sell the securitized subprime loan to the buyers. So this is simple, but when we repeat buying and selling the speculated subprime loans, then it's gonna be complicated. So due to the repeated buying and selling of securitized subprime loans, it became difficult to tell who was at risk of not being repaid on mortgages. So it's hard to identify who has subprime loans and who faces the risk of unpaid loans. Okay? But banks around the world, especially in the US and the European banks, aggressively purchased securitized subprime-related assets. So banks around the world, especially US and Europe, got caught in unpaid loans due to falling home prices. When home prices started to falling, then the banks around the world faced the risk of unpaid loans, subprime loans. Okay. Oh, too small. Okay. In 2007, subprime borrowers increasingly struggled to make payments. Then, lenders around the world became aware of the risks and withdrew from the market. In early August 2007, the Federal Reserve, the central bank of the US, provided the largest liquidity support since 9/11. So you know that 9/11 is the 9.11 is the terrorism. In Japanese, 世界同時多発テロ, I guess. But sorry, I don't know the English name, but 9.11 is the terrorism. So in early August 2007, the Federal Reserve provided the largest liquidity support since 9.11. August 9, 2007, major French bank BNP Paribas revealed that three of its investment funds face funding problems. Then market panics. Each bank pulled cash. Each bank accumulated cash and with fearing that the other banks would fall and become unable to repay their loans or it's hard to obtain interbank funding. Then, against such situation, ECB conduct lender of the last resort. ECB and Fed conducted the lender of the last resort, but the stock market was falling despite of the lender of the last resort. In late 2007, the lack of credit and collapsing home prices, housing prices, and sent the US economy into recession. So in the late 2007, the US economy faces recession. Oh, sorry. March 2008, Bear Stearns, a major investment bank, which is fifth largest in the US, that has been involved in large-scale subprime-related investment, faces a substantial loan on its assets. Lending institutions refused to refinance short-term bonds of Bear Stearns. Fed bailed out in a hurry for the Bear Stearns. Even so, financial markets remain unstable. Foreclosures due to overdue mortgage loans in the US increase, and housing prices continue to fall. Then, September 15, 2008, the failure of Lehman Brothers. Lehman Brothers is a major US investment bank. So, due to this failure, the global financial crisis is known as the Lehman shock in Japan. So in Japan, the global financial crisis is also called as Lehman shock. The next day, September 16 in 2008, American International Group, AIG, a major insurance company in the US, fell into crisis. Then the Fed immediately intervened and provided $85 billion in loans. AIG also receives a huge loan from the government. So repeated crises occur in major financial institutions, Lehman Brothers and AIG. So such chaos after Lehman Brothers collapse spread to European countries. So in the European country, many financial institutions failed. And then EU government announces blanket deposit compensation to prevent bank failures. But already the economic downturn has spread around the world with devastating effects on production and employment worldwide. So this is a global financial crisis. Okay? So you can see, so this is a graph of US housing price. So you can see that there is upper trend, mostly upper trend from the 1965 to 2020. And here is global financial crisis. So before global financial crisis, the housing price was increased. The housing price increased since around the 2000. Since around the 2000, housing price increased. But around 2006, the housing price started to going down. Okay, and during the global financial crisis, housing price was keep falling. So this is the US short-term interest rate. You can see that this gray area is global financial crisis. You can see that around here, before the global financial crisis, the interest rate increased up to the 2006. Sorry. But then the interest rate began to decreasing since around 2006. Then please focus on this area. Around this area, interest rate little bit increased, falling down, but little bit increase around here. So this hike of interest rate causes the panic or the decline of housing prices. So this falling down in the interest rate causes the boom of housing market. Then a little bit increase in here causes the decline in the housing market, housing prices. Then economy into the recession, then Federal Reserve decreases the interest rate to almost zero around here. And this low interest rate kept in about 2016. Okay, this is the US short-term interest rate. Oh, sorry. Okay, so this is the US real GDP. You can see that there is upward trend around almost all period. US GDP goes up overall period, but the notable point is that the during a global financial crisis, the economy, the GDP going down here. You can see that there is L-shaped curves. L-shaped, L, here. L-shaped curve here around the global financial crisis. So this type of recession is called L-shaped recession. So the feature of L-shaped recession is the economy goes down, but never back to the normal standard trend. Okay, economy moves down, going to down, but the trend here, the trend never back to like that. So the trend never back to the normal trend, but still the trend is low. So this is the L-shaped recession. In the L-shaped recession, the trend never back to the normal, but the trend keeps to the low trend. This is L-shaped recession. In contrast, here, the spike is COVID-19. So the disaster of COVID-19. During the COVID-19 crisis, economy falls, but soon go back to the normal trend. In the COVID-19, the economy falls, but soon going to the normal trend. Okay, so the trend is same between and after the crisis. So this is COVID-19. So such recession like COVID-19 is U-shaped recession. So it's confusing because it seems to be V, but this type of recession is called U-shaped recession. U-shaped recession. So this is U-shaped recession. And this global financial crisis is L-shaped recession. So global financial crisis is L-shaped recession and the COVID-19 crisis is a U-shaped recession. Okay, so this is the US real GDP. Oh no, let's check the unemployment rate. Unemployment rate. Okay, around here is global financial crisis. So you can see that during the global financial crisis, unemployment rate increased. Then gradually go back to the normal level. And this is a COVID-19 crisis. This is a COVID-19 crisis. You can see that the unemployment rate increased a lot compared to the global financial crisis. But COVID-19 crisis, under the COVID-19 crisis, the unemployment rate soon back to the original level. During the COVID-19, unemployment rocket up, but soon go back to the initial level or normal level. In contrast, in the global financial crisis, the unemployment rate increased but less than COVID-19. But it takes so much time to converge into the original level. Okay, during the COVID-19, unemployment increased a lot, but soon the unemployment go back to the original level. But the global financial crisis, the unemployment rate increased but less than COVID-19, but it takes so much time to converge to the initial original level. So this is the effect difference of COVID-19 and the global financial crisis. Okay, so this is the US unemployment rate, okay? So now we compare the impact of real GDP of US and Japan. So you can see that blue line is US real GDP and red one is Japan real GDP. So you can see that along the global financial crisis, the red one, Japanese case, is lower than the United States, the blue one. So you know that US is the center of global financial crisis, but Japan is just a trading company, trading partners to the US. But Japan faces much more severe effects on the real GDP compared to the US. Why? So to answer this, we need to remind y equals c plus I plus g. Y equals c plus I plus g plus nx. Do you remember? Output GDP should be equal to the consumption C, investment I, government spending G, and NX, net export. And here, net export is the export minus import. So the real GDP can be divided into these four parts. And the notable point is that the export here explains the large part of the decline in real GDP. So you can see that in the graph, red one is the decline in real GDP, and blue one is the decline in real export. So you can see that around the global financial crisis, the decline in the real GDP around the global financial crisis here is mostly explained by the decline in real exports, like here. So therefore, Japan faces several decline in real GDP because the real exports declined a lot due to the global financial crisis. Due to the global financial crisis, world demand shrinked. So the world demand shrinked, and then exports caused huge damage. So Japanese exporting companies faced a huge decline in the profit. So therefore, Japanese exports declined a lot, and this decline in the real exports causes the huge decline in real GDP. Okay? So far, we reviewed the effects of global financial crisis and the causes and effects of global financial crisis. And then move on to another topic, international regulatory initiatives after the global financial crisis in the next video.